are you truly investing into the entire US market when you purchase an S&P 500 ETF? The S&P 500 index, the biggest index in the entire world and one that tracks the performance of the largest US companies. It's arranged by market capitalization, market cap. This means that the largest company in the index, Apple, has the heaviest weight in the index, and the smallest company in the index, Albemarle, has the lightest weight. The market capitalization of a company is calculated by multiplying the company's stock price by the number of shares outstanding, and it's rebalanced every quarter. And the weights of the company in the index are adjusted to reflect any changes in their market capitalization. So we've got Apple as the largest by weight, coming in at 7.8%, followed by Microsoft, Amazon, Nvidia, and Alphabet. So these top 5 companies in the S&P 500 account for 22.36% of the entire index. This means that out of the entire 500, 503 companies featured, just 5 of them, so just 1% of them, account for nearly a quarter of the entire index. This feels really disproportionate, and it's because it's all calculated by market cap. If we then expanded this out further to include the top 10 companies, they would weigh 30.28% of the entire 100% index. And you've probably already noticed, but the top 5 positions are all held by tech stocks. This is highly impactful for the index, and when we see a tech boom like we've been experiencing this year so far, it means that the S&P's 500 performance also goes up. But when we're experiencing tech stocks crashing, because at the end of the day, they are growth stocks and they're very volatile, and they especially don't do very well during recessionary periods or periods of high inflation and high interest rates, then the index is also negatively impacted. In 2022, the tech stocks fell. We saw some of them, like Meta, drop by about 70% of their value. And this was largely due to the Fed hike rise. This, of course, negatively impacted the index, which plummeted also. So you can see that the performance of just a few big companies, all concentrated in just one sector, highly impacts and controls the majority of the movement of the index. Investors in the S&P 500 index may think that they're getting exposure to a diversified basket of 500 companies. And whilst they are to some degree, these mega cap companies are accounting for more and more of the index as time goes on. During the tech bubble in the late 90s, early 2000s, the top 10 comprised of 25% of the index. Now we're seeing that sitting at more like 30. So although it is more concentrated now than it has been in the past, it is important to point out that throughout history, it is normal that a small number of companies are the outsized drivers of the stock market gains. A few years ago, it was the FANG companies, Facebook, Apple, Amazon, Netflix, Google, as Alphabet was then known. And these were the engines of the stock market. In the late 1990s, we had the 4 horsemen. We had Intel, Microsoft, Cisco, and Oracle. And in the late 60s, early 70s, it was the Nifty 50 that moved the market more than any others. Whilst this feels pretty good right now if you're an investor into an S&P 500 ETF, whilst the tech stocks are doing really well, it also means that the reverse could happen. If growth begins to fall later this year and this AI bubble, that some people are calling it, bursts, then the index could experience a large downfall. The S&P 500 is known to return on average 10% to the investor every year. But what happens if you actually remove those tech stocks from it? Well, firstly, let's compare the performance of the 5 largest companies compared to the rest of the index. You can see that it's vastly different here, but it's worth pointing out that this is just year to date, so a short period of time. But you can also see that the volatility is much larger. The drops are deeper, the peaks are higher. The S&P 500 index as a whole tends to be more stable and more consistent. And that's why a lot of people prefer investing into this as opposed to picking individual stocks. It's much nicer on the stomach. Then I found this amazing graph, and it's showing the S&P 500 versus the S&P 500 when the tech stocks are removed. It shows that the index experiences a lot less growth as a whole if you actually do remove these growth stocks. It drops from about 8% to about 2% in this time period shown. You can see the Nasdaq shown here here as well, which if you're unfamiliar with is a very tech heavy index, and it's doing the best this year. According to one source that I actually looked at, without the big 5 companies, the overall market including dividends would be up just 1.5% this year. And then if you also remove the contributions from the other 2 largest players, which are Meta and Tesla, the S&P 500 would actually be slightly underwater this year. So that goes to show you the impact of those big tech companies and the 5 largest in the S&P 500. Now we know that these companies have been doing very, very well this year. The excitement over AI has really boosted the shares of Microsoft, Google's parent, which is Alphabet, and Nvidia, as these companies have very close ties to technology. Also, Apple and Amazon have also benefited from being tech stocks and having this AI boom that is going around at the moment. But also it's worth pointing out that these two have been doing very, very well since they got really strong earnings. Much stronger earnings than were expected during the current consumer slowdown. The concerning point is the dominance of the tech stocks in the index for investors wanting stable returns, somewhat reliant returns, because it makes the index pretty vulnerable because these stocks all come from the same industry. So they are all affected by the same macroeconomic factors. A big reason that investors buy an ETF or an index fund tracking the S&P 500 is to diversify their portfolio, to get exposure to all of the largest US companies so you don't have to run the risk of owning too few stocks. But with just 5 of them absolutely dominating the index, could you argue that actually you're not getting true diversification and therefore you're not truly lowering your risk? Well, actually, those shifts in the index's concentration doesn't really impact the risk levels over a long period of time. If anything, it lowers the risk. Well, let's for example take IBM, which in the 1990s was the leading tech company of the entire world. And it's why IBM held the #1 spot in the S&P 500 index, whereas Apple at that time sat at 107th. But we all know now that this is the reverse. Apple now has the largest weighting in the S&P 500. And this is because the index has undergone a risk adjustment. You as an investor haven't had to do anything, but the index has done this rebalancing itself. The market cares about earnings above anything else because generally speaking, really high level generally speaking, the companies that make more money, that have better revenue, that make better profits are the sturdier, more stable companies. Now, Apple makes billions in net income in a given year, whilst other companies may actually be losing money. So as an investor, would you rather Apple take a bigger percentage of the S&P 500 or maybe one of these other companies that are losing money? It's not really hard to tell which is the safer bet. The S&P 500 would almost certainly be riskier to you as an investor if it didn't favor the more valuable companies. Let me know if you have an S&P 500 ETF in your own portfolio, and if you want to join my Patreon where you'll get access to the exclusive Discord where we chat every day about different stocks, investing strategies and all that good stuff, even film recommendations and fun things like that, I'll leave a link in the description below. It's less than a cup of coffee per month. Hope to chat to some of you guys over there soon. Thank you so much for watching and I'll see you soon in another video.